In the previous lesson, you learned how to read candlestick patterns. But here's the truth. Candles alone are not enough. You need to know where to use them, because a perfect candlestick pattern in the wrong place will fail, and a simple pattern at the right level can become a high probability trade. That's why in this lesson, you're going to learn one of the most important foundations in trading: support and resistance. Look at this chart example. As you can see, the market moved up, reached this level, and then reversed. It came back to the same level again, formed a Nagaraboshi candlestick, and as a result, the market moved down. Now look at another chart. The market reached a level, reversed, then came back again and formed a doji candlestick. And what happened? The market moved up. So why does the market react so strongly at these levels and move toward the target? Because these are what we call strong key support and resistance levels. And if you know how to identify and draw them correctly, you'll already be ahead of 90% of traders. Here's what you will learn in this video: how to identify strong and weak support and resistance, why most traders draw levels the wrong way, how price reacts at key levels, what buyer and seller behavior really looks like, how support becomes resistance and the opposite, how to find high probability trade entries, how to avoid false signals using price action. At the end of this video, you will be able to spot, draw, and trade support and resistance with candlestick patterns. Before we dive in, if you want to learn more powerful trading lessons and price action techniques, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next lesson. Now, let's get started. To identify a strong support or resistance level, there are 6 key criteria you need to follow: major swing highs and swing lows. Start by focusing on the most significant turning points on the chart. A strong support or resistance level is always built around a clear rejection zone, either the highest peak or the lowest point of a recent price movement. These extremes reveal where buyers or sellers stepped in with strength, and this is why price often comes back to react at these same levels again. Multiple price rejections. A level gains strength every time price reacts to it. When the market tests the same zone multiple times without breaking through, it signals that strong players are actively protecting that area. You can think of it like a barrier. The more times price hits it and gets rejected, the more powerful and reliable that level becomes. The level must be obvious. A strong level should be easy to recognize at first glance. If you have to force it or look too hard to find it, then it's probably not a valid level. The best support and resistance zones are the ones that stand out immediately when you open the chart. Simple, clean, and clear. Strong and aggressive reactions. When price moves away from a level with speed and momentum, forming large candles and sharp movements, it indicates strong buying or selling pressure. The more powerful the reaction, the more significant that level becomes. These explosive moves often reveal where institutions have entered the market and left their footprint. Role reversal. This is one of the strongest confirmations you can get. When a resistance level is broken and later acts as support, it shows that the level is valid and respected by the market. The same principle works in the opposite direction. This type of behavior is a clear sign of smart money activity. Recent respect of the level. Fresh levels are always more relevant than older ones. A level that has been tested recently carries more significance than one formed a long time ago. The market reacts to current conditions, not outdated price action. That's why you should always prioritize the most recent reactions when marking your levels. Before moving forward, there's an important point to keep in mind. A support or resistance level doesn't have to satisfy all 6 criteria to be considered valid. However, the more criteria a level meets, the stronger and more reliable it becomes. Let's jump into real examples and break it down step by step. Look at this chart. As you can see, the market reached this level and reversed. It moved up again, tested the same level, and reversed once more. So we draw this level. Now the question is this a strong support or resistance level? Yes, it is, because it is clearly visible and price has already rejected it multiple times, first here and then here. This tells us we are dealing with a high-quality resistance level, so when the market approaches this level again, we expect another rejection to the downside. Now look at what happens next. Price returns to the level, gets rejected again, sweeps liquidity above it, and then moves down as expected. Now look at another chart example. Here the market was trending down, then reached this level and reversed. This is a key support level. You might be asking, why? First, the level is obvious. You don't need to spend time searching for it. It stands out immediately. Second, it has been respected recently, which means it is still fresh and relevant. Third, it aligns with a major swing low, while the level above represents a major swing high. With these criteria combined, we can say this is a high-quality support level. Now look at what happens next. As you can see, when the market returned to this level, it was rejected once again and moved upward as expected. Now look at this chart example. As you can see, the market reached this level and reversed, forming a clear resistance level. This is a key resistance level because it is obvious, it aligns with a swing high, and it has been respected recently. So, naturally, when price comes back to this level, we expect a rejection. But look at what happens next. Price returns to the level, and instead of reversing, it keeps moving up. So the question is, if this level meets the criteria of a high-quality level, why didn't it work? The answer is simple. A key level on its own is not enough. A support or resistance level is just an area where price has a higher probability of reacting, but it does not guarantee a reversal. That's why we need additional confirmation before entering a trade. And one of the best tools you can use is what you learned in the previous lesson, candlestick patterns. A support or resistance level shows us key areas of interest in the market, and candlestick patterns show us how price is likely to react at those areas. Now let's combine candlestick patterns with support and resistance to see how it works. Look at this chart example. As you can see, the market is trending down. The market breaks below this support level and then retraces back to it. The support level becomes resistance, and once price retraces back to it, a doji candlestick pattern forms. After the doji formation, the market moves down. Here we have another support level that was broken, and the market is retracing back to it. So this support level has turned into resistance, and we will see how the market reacts to it. As you can see, the market retraces back to this support level that has become resistance, and look at what happens. The market forms a clear Nagaraboshi candlestick pattern. Now look at what happens next. As you can see, the market moves down as expected. So why did this key resistance level work? First, because it is an obvious level. Second, because it meets one of the strongest criteria, which is role reversal. This means that the support level was broken and then turned into resistance, in line with the downtrend. But that alone is not enough. It only tells us that this is a high-quality area. When the market retraces back to it, a Nagaraboshi candlestick pattern appears. This validates the level because the Nagaraboshi indicates that buyers tried to push the market higher to break the level, but they failed and the market closed below it. The Nagaraboshi confirms this area and shows that this resistance level marks the end of the retracement move and the beginning of a new impulsive move downward, and that's exactly what happens. Now look at this chart example. As you can see, the market moved down, hit this level, and reversed, forming a clear support level. Let's use our criteria to see if it is high quality or not. The level is obvious. It is a major swing low, and it was recently formed, so it is fresh. So the level is strong. But let's wait for the market to retrace back to it and see what we get. As you can see, the market retraced back to it, and a Tonkachi candlestick pattern formed. The Tonkachi indicates that sellers tried to push the market below the level, but failed, and buyers took control. This happened at this support level, which is a hot area in the market. So by using candlestick patterns, we can validate the level and say that the market is likely to move up. Look at what happened. As you can see, the market moved up as expected. Now look at another chart example. As you can see, the market was trending up. It reached this level and reversed, forming a clear resistance level. The level is obvious. You don't need to spend hours to find it when you open your chart. It is recently formed, which means it is fresh, and when price comes back to it, a reversal is likely to happen. So now, let's see what happens. As you can see, once the market reaches the level, a bearish Tsutsumi pattern appears. The bearish Tsutsumi pattern is a reversal pattern when it forms at the end of an uptrend. If you want to learn more about it, check the previous lesson where I explained everything in detail. So the formation of this pattern indicates that the market is likely to reverse and that this key area is valid. Look at what happens next. As you can see, the market moves down. Now you know the criteria of a high-quality support and resistance level and how to combine it with candlestick patterns. Let me now show you how to draw these levels on the chart, as this detail is very important. Now let's look at this chart example on the Australian dollar Canadian dollar 5-minute chart. As you can see, price reacts multiple times at the same level. In this case, all the reactions are very clean and aligned, so drawing a single horizontal line here makes perfect sense. The wicks, the closes, everything respects the same level. Now below, there is a support level. Let's draw it. As you can see, price does not respect this level precisely, so instead of drawing a single line, we mark a zone that covers these reactions and these reactions. And as you can see, here we have a resistance level drawn as a line, and here we have a support level drawn as a zone. Now look at another example. Here on the British pound US dollar 5-minute chart, as you can see, we have multiple reactions at this resistance level. So how do we draw it? We try to cover all reactions by drawing a resistance zone instead of a single line. Below, we have this level that starts with this reaction, and another reaction here. So here as well, we draw a zone. Now we have two clear levels of support and resistance. Now look at what happens. When the market comes back to the support zone, it enters the zone and gets rejected. So as you can see, by treating support and resistance as zones instead of single lines, your trading becomes much easier. Now that you understand how to identify and draw strong support and resistance levels, and how to use them in your trading, the next tool you need to learn is trend lines. Trend lines help you understand the direction of the market and how price moves over time. They allow you to spot where pullbacks may end and where the next move is likely to start. With trend lines, you can follow the flow of the market more clearly and anticipate potential reactions before they happen. Let's break it down. A trend line is one of the simplest yet most effective tools you can use in technical analysis. It's a line drawn on your chart that connects key highs or lows when the market is trending. Trend lines help you understand the direction of the market, spot potential pullback areas, and find better entry opportunities. In a downtrend, price moves in a repeating pattern of waves, a strong move downward, followed by a pullback, then another move down. To understand this structure, the lowest point before price starts pulling back is called a swing low. The highest point before the next move down begins is called a swing high. In a strong downtrend, price consistently forms lower highs, lower lows, and these lower highs are the key points we focus on. To draw a trend line in a downtrend, you connect the swing highs along the top of the price action. This creates a downward sloping line that acts as dynamic resistance. To draw a trend line in an uptrend, connect the swing lows along the bottom of the price movement. This creates an upward sloping line that acts as dynamic support. These are the areas where buyers are more likely to step back into the market. But keep this in mind, the market is not always this clean. Price doesn't move in perfect patterns or straight lines. However, understanding this structure will help you read market movement more clearly and trade with greater confidence. Now let's answer an important question. Why do we even use trend lines? There are two main reasons traders rely on trend lines. In an uptrend, a trend line works as dynamic support. When price pulls back toward it, it often finds support and continues moving higher. In a downtrend, a trend line acts as dynamic resistance. Each time price retraces back to it, the market often reacts and moves lower. But here's a key rule you must follow. Never enter a trade just because price touches a trend line. Always wait for confirmation. And later in this video, I'll show you exactly how to confirm trend line trades properly. Trend lines are not only useful for following the current trend, they can also help you spot when the market may be changing direction. In a downtrend, the trend line is drawn above price. If price breaks above this line, it can be an early signal that the market may be shifting toward an uptrend. In an uptrend, the trend line is drawn below price. If price breaks below it, this may indicate a potential shift toward a downtrend. But keep this in mind. A trendline break alone does not confirm a reversal. You still need additional confirmation before making any trading decision, and we'll cover exactly how to confirm these moves in the next section. Now that you understand what trend lines are and why they matter, let's go over the key rules to draw them properly. These principles will help you stay consistent and avoid common beginner mistakes. To draw a valid trend line, you need at least 2 points of contact. The more times price reacts to it, the stronger it becomes. But keep this in mind. More touches do not guarantee that the trend line will hold in the future. It only shows that price has respected it in the past. A trend line is not an exact level, it's more like a guide. Price will not always react exactly on the line. Sometimes price will reverse before reaching it, sometimes it will break through and come back, and other times it will hover around it before moving away. In this example, price reacted from the general area of the trend line without touching it perfectly, and the same thing happens here. This shows that trend lines represent zones, not precise prices. But you should still draw them and stay consistent in your approach. And here, we finally see a clean reaction. Price pulls back, touches the trend line, gets rejected, and continues moving higher. This is what a textbook trend line reaction looks like. This is one of the biggest mistakes traders make. If the trend line is clear and fits naturally with the market structure, draw it. But if you have to force it, then it's not a valid trend line. Here's an example. The first trend line we drew was incorrect because we ignored an important touch point just to make the line look cleaner. That's what we call forcing a trend line, and it's a common mistake. The correct approach is simple. Identify the true swing highs or swing lows, draw the trend line based on those points, then wait and observe how price reacts. Never adjust your trend line just to make the chart look better. Let the market guide your analysis, not your expectations. One of the most common questions traders ask is, should I draw my trend line using the wicks, the candle bodies, or a mix of both? Here's the simple answer. Use whatever gives you the most consistent touches. Trend lines are not about being perfect. They're about connecting price in a logical and consistent way. Now let's break it down. Here we have a clear downtrend. Now, when we draw the trend line by connecting the maximum number of swing points, we notice something important. In some areas, the line aligns perfectly with the wicks. In other areas, it slightly cuts through a wick to connect with the candle body, and sometimes it connects a mix of both. This is completely normal, and this is exactly what we want. The objective is to connect as many relevant points as possible, not to follow a strict rule. The more touches the trend line has, the more reliable and meaningful it becomes. Now let's focus on the trend line drawn from the swing lows. Just like in the previous example, you'll notice some variation. In some cases, the line aligns with the wick lows. In others, it connects better with the candle bodies. And sometimes, a combination of both gives the most consistent result. This is completely normal. Your goal is to connect as many meaningful points as possible, not to draw a perfectly precise line. Now, let's combine trend lines with candlestick patterns to find high probability trade entries. Look at this chart example. This is the Euro-US dollar on the 5-minute time frame. As you can see, the market starts moving downward, showing that sellers are currently in control. In this type of market, traders often look for potential selling opportunities. Now let's connect the swing highs to see if we can identify a valid trend line. By linking these points, we form a clean downward sloping trend line. Once the trend line is drawn, the next step is to wait for price to retrace back to it and observe the reaction. Here, when price pulls back to the trend line, it reacts strongly and forms a clear bearish pin bar. This kind of rejection suggests that sellers are stepping back in and defending the trendline area. Before considering any trade, it's important to look at the higher time frame. On the 30-minute chart, the market structure is still clearly bearish, which supports the setup we see on the 5-minute chart. When both time frames align, the setup becomes more reliable. Now let's go back to the 5-minute chart. Some traders wait for the confirmation candle to close before entering, placing their stop loss above the trend line or the nearest resistance to manage risk. The target is usually set to achieve at least a 2-to-1 risk-to-reward ratio, depending on the situation. Now look at what happens next. Price continues moving downward and eventually reaches the target. This example shows how combining a trendline pullback, candlestick confirmation, and higher time frame alignment can help you read the market more clearly. Now let's look at another chart example. This is the Australian dollar Japanese yen on the 5-minute time frame. As you can see, the market is moving downward, so we start by connecting the swing highs to draw a trend line. Here, we're able to connect 3 clean points, giving us a well-defined and respected trend line. Since price has already reacted to this trend line multiple times, when it retraces back again, traders begin to watch closely for signs of continuation. Now look at what happens next. When price returns to the trend line, it forms a clear pin bar rejection. Shortly after, a second pin bar appears in the same area. So even if you missed the first signal, the second one offers another confirmation that sellers may still be in control. Now let's check the higher time frame. On the 30-minute chart, the market was previously moving up, but then formed a first top, followed by a second top. This creates a potential double top structure, which can signal weakening bullish momentum and a possible shift to the downside. This higher time frame context supports what we're seeing on the 5-minute chart. Now let's return to the 5-minute time frame. Some traders wait for the pin bar to close before entering, place their stop loss above the trend line or nearby resistance, and aim for a target that offers at least a 2-to-1 risk-to-reward ratio. Now look at what happens next. Price continues moving downward and eventually reaches the target area. The same concept can be applied in an uptrend, and it also works across different time frames, such as the 1-hour, 4-hour, or even the daily chart. It's a flexible approach that helps you understand trend continuation and read market structure more effectively. Now you have something most beginner traders don't. You know where to look, how to draw your levels, and how to wait for confirmation before entering a trade. And that alone can completely change the way you see the market. But this is just the beginning. In the next lesson, we're going to take this even further and show you how to turn all of this into a complete trading approach. So if you're serious about learning how to trade the right way, make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss the next lesson when it drops. Thank you for watching, and I'll see you in the next video.